So class 17, the second video got cut off after 13.5 minutes. So let me start where we went there. The last thing I was doing was showing you the average for the up markets. Remember, this column was up markets and this was down markets. So the average return for Fidelity contra fund and up markets was 3.32% versus the benchmark was up 3.69, so they actually underperform a little bit in up markets, but in down markets they're down 2.23, where the benchmark is down 354. So they really outperform in down markets. And so to get the upside downside capture, you just do their return, average return in up markets divided by the benchmark's average return in up markets. You can see that in up markets they capture about 90% of the market. And then in down markets, the exact same thing. You just take their average in a down market versus the benchmark. And what you'll normally find with up and downside capture is most of the managers we hired when I was at USA, they had this type of scenario where they didn't capture all the upside, but they were really risk protected on the downside. That's the more normal. It's going to be very rare to find a firm that's 110% on the upside and 70% on the downside. So most firms will either be aggressive, and so they outperform in up markets, also have worse returns in down markets. So they're good in up markets and even worse in down markets. Are they slightly underperform in good markets, but materially outperform in down markets? So there's the formulas there. Very, very straightforward. So before we get into the next video, especially given that the videos part 2 of 17 was a little bit blurry, let me review all the columns again. So we brought in the dates and the contra funds adjusted price. We went back to 1987 because the data I have starts in 98. We brought those in. I then did the holding period return for the contra fund, where I just took its return for 1 month divided by the prior month's return minus 1. I brought in the S&P 500 and the large cap growth from the asset return pace value page. Remember there, it starts in 1988. I brought in T-bills, which we'll use for the Sharpe ratio and a few other ratios. I got the alpha. Remember, the alpha was simply taking their holding period return for the contra fund minus the return for the large cap growth. I then looked at up market capture. So I said, if the large cap growth was positive, what did the contra fund do? And right next to that, if the large cap growth was positive, what did large cap growth do? The downside capture, essentially the exact same formula, you just changed the greater than to less than. If the large cap growth is positive, what did the contra fund do? If the large cap growth was was negative, excuse me. If the large cap growth was negative, bring in the contra fund. And then bring in that, but if not, just give me nothing. That's why I put those two quotes at the end. So hopefully you can see that better. Then the linked returns. The linked returns, I just started with 1, and I took 1. I took that previous cell times, parentheses 1 plus the return for my fund, and I did the same thing for 1 plus return large cap growth. I copied that down. So I got the cumulative returns, which means if you invested $1 in a contra fund, you would have had $67 today, versus only $22 for the index. And remember, on the index, we're using a total return index. So this isn't, they're not getting penalized because the index doesn't include dividends. It should include dividends. And then the batting average, all I said is, if the contra fund had a higher return, give me 1. If it had a low return each month, give me 0. And remember, I was worried last time because they've really not outperformed much in the last several months. So at the bottom of this column, I did the averages for the upside downside capture. I put the number of periods here. I just did the count function, and then you can see the formulas over here. You can probably see them better on this video than the previous video. So here's all the functions and formulas there. So hopefully that helps you a little bit more to be able to see it. And sorry that previous video got cut off.